Before I begin to this video, let me give a quick disclaimer. I am not a financial advisor. The content of my videos represents my personal opinions and is provided for informational and entertainment purposes only. My information is not intended to be legal, financial, or an investment advice. Always conduct your own research and due diligence before making any financial decisions. Remember, it's your money. Please make informed decisions that are right for you. I'll never ask you for money, nor will I provide my phone number or personal email address. If you encounter any suspicious accounts or messages claiming to be me, please report them immediately as fake or scam accounts. Welcome back to Talk Stocks with me, and a warm welcome to our new viewers. This is your weekly market digest where we focus on data-driven insights, cutting through the hype, fraud, and emotion that often cloud decision making. As always, we'll recap the global markets, review the NGX market channels, and we wrap up by highlighting short-term trading opportunities in the US market. Let's get started. Before we begin with a recap of the past week's market performance, let's remind ourselves about the goal or purpose of this slide. Here are the key technical markers that are used to identify a bullish trend or a bearish trend. We want to identify a bullish trend when the close price is greater than the 20 exponential moving average and the plus DMI is greater than the minus DMI and the ADX is at least 20 and above. Conversely, a bearish trend is identified when the close price is less than the 20 exponential moving average and the minus DMI is greater than the plus DMI and the ADX is at least 20 and above. A neutral trend is when we are not able to identify a bullish nor bearish trend. WTD stands for week to date, YTD stands for year to date, and PY stands for previous year. Again, we're only going to focus on the indexes where we believe that viewers can benefit in the short to mid term. We begin this week's recap with the US small cap stocks, which we track by the performance of the ETF VTWO, which is an ETF that is managed by Vanguard. This past week, it printed 2.55%. Year to date, VTWO has delivered a return of 7.62%. You can see it's getting close to its last year's overall return of 11.41%. In the short term, a neutral to slightly bullish trend is developing, which was identified on the daily time frame, and the mid-term, a bullish trend can be observed from the weekly time frame. The Nigerian equities, which we measure by the NGX ASI, this past week returned 3.84%. Year to date, the ASI has delivered 10.36%. In the short term, the daily chart points to a strong bullish trend, and in the mid-term, the weekly chart is pointing to a strong bullish trend. We move to gold commodity, which we can track by the ETF GLD. This past week delivered 4.94%. Year to date, GLD has delivered 14.93%. In the short term, a bullish trend can be identified from the daily time frame. In addition, in the mid-term, a strong bullish trend can be observed studying the weekly chart. Silver is another commodity which has done well this year. Year to date, SLV, which can be used to track silver, has delivered 8.96%, and it's showing a strong bearish trend in the short term, but is bullish in the mid-term. I also like to call out oil, which we track by the ETF USO. This past week, it returned 1.97%. Year to date, USO has delivered 11.32%, significantly outperforming its entire 2025 return of negative 8.46. The short term is showing a bullish trend from the daily time frame, but in the mid-term, the chart is still neutral, which is identified from the weekly time frame. Let's switch to the next section where we go in depth into the NGX ASI via our market internals. Welcome everyone to this week's NGX market internals. Remember, the market internals provide a data-driven look at the breadth and strength of the Nigerian stock market. As a reminder, the Nigerian stock market comprises of 144 stocks which fall under various sectors comprising of the industrial sector, consumer goods, industrials, oil and gas, banking, to name a few. The purpose of the market internals is to look under the hood of the market to see how efficient or rotten the market is performing. In the market internals, we typically score the market as either strong, the green ball, neutral, the yellow ball, or weak with the red ball. Each of these scores represents broad participation when you have a green strong market, fair participation when you have a neutral score, and narrow participation. And what I mean by participation is what sectors or the quantity of sectors that are driving or fueling the market. This week we are giving the market a healthy score of strong broad participation. You can see by the green ball and our comment of advancing and healthy market. However, it's important to realize that these scores are arrived using some technical indicators or some technical framework. The first of which is the moving average breadth. And from the moving average breadth, we typically use the percentage of stocks that are trading above their respective 50-day moving average. You can see clearly that we ended the week with 50% of stocks within the NGX ASI to be trading above their respective 50-day moving average, compared to 82% the previous week, right? And this is a negative 2 percentage points change. Remember, when we're back in school, when you have a score of 80%, that is actually a grade, right? Or A plus, depending on the scoring formula you typically utilize in your school board. So we're going to give the NGX ASI an A plus for the percentage of stocks trading above their respective 50-day moving average. Again, another statistics that we use to track the health of the market using the moving average breadth statistics is the percentage of stocks that are trading above their respective 200-day moving average. You can see that we ended the week with 82% of stocks trading above their 200-day moving average compared to 81% the previous week, which represents a positive 1 percentage points change. Again, 82% is an A plus. So the two KPIs within the moving average breadth framework have an A plus grade, which is excellent. The next framework we use to track the health of the market within the market internals framework is the Winston stage analysis. And what we are looking for are the percentage of stocks that are in the advancing stage. Remember, every financial instrument, its life cycle can be classified into 4 stages. Yeah? You have the accumulation, you have the advancing, you have the topping, and you have the decline. So we're looking at the percentage of stocks that are advancing within the NGX ASI. Our statistics is showing us that 78% of stocks are trading above, are trading in stage 2 advancing, which is similar to what we had the previous week. So that's why we have a flat week over week change. I mean, 78% is also A, right? Let's be real. We don't have to be strict examiners or strict professors. So we're going to give this an A score. The next metric we also use within the Winston framework is the percentage of stocks that are in a strong advancing stage. You can actually see we went up by 2 percentage points this week. You see we closed the week with 56% compared to 54% the previous week. I'm really excited about this market. The market looks to be firing well, so if you're in the market, congrats. Continue to enjoy the market, and we'll keep tracking the internals. Before we end this section, let's also look at the major index or sectors within the market, and let's classify them with our framework, which can either be strong advancing or advancing or declining sectors, right? The goal here is to see where you can get action as a trader or an investor. So you can clearly see the NGX ASI is strong advancing, the NGX 30 is strong advancing, the consumer goods, oil and gas, industrial, insurance, and banking, all the key sectors and indices are in a strong advancing phase. This is very bullish. This is telling you the market is bullish. The market is firing in all cylinders. All we have to do as investors or traders is to participate, manage risk, and lick our profits. Remember, market internals help us to see beyond the index. Are many stocks and sectors participating in the move, or just a few? Looking for trading opportunities in the US market this week? Well, I followed the forest to trees approach. What that implies is I look at the index, which if I'm trading the large cap market is the S&P 500. I want to understand, is the market trending up or trending down or staying sideways, right? There's a famous saying that a rising tide floats all boats. So I want to understand whether the tide is rising or not. Once I've established the tide is rising, I then look at the various sectors within the, assuming I've focused on I want to trade the US large cap this week, I am able to identify which sectors are fueling the large cap stocks, right? So the S&P 500 comprises of 12 sectors. Here is my framework or my measurement framework that is showing me the sectors that are exhibiting a strong short-term momentum, right? As a short-term trader, I want to focus on strength, right? And align myself with the strength, right? So here my framework is showing me that the energy sector, consumer staples, industrials, materials, financials, and real estate are showing relative strength compared to the overall market. Just as a reminder, within this figure I have two shades of green. The lighter shade of green here, if you focus on the energy, which is showing a return of 6.29% this month. So this means if you have bought the ETF XLE, which tracks the energy sector, you will be up 6.29% this month, and within the last 3 months you will actually have been up 17.58%. Similarly, if you look at industrial sector, which you can participate by the ETF XLI, meaning if you have bought it from the beginning of this month, you will be up 4.82% in your portfolio, and if you've held this ETF for the last 3 months to date, you'll be up 13.53. So this is one way. There are many ways where you can identify which sectors are showing strong momentum. This is one way. Remember, there are many ways to skin a cat, right? This is just a method that I've created for myself, a system I've created for myself. So now that I know the sectors that are hot, I can either buy one of these sectors using technical analysis to time my entry and proper risk management, or I can look for the hottest stocks within these sectors that are outperforming the S&P 500. So what I have here is an example of the stocks within the industrial sector that are outperforming the market, right? So these are the hot stocks in the hot sector. Again, you have to use technical analysis to time your entry, right? Again, I'm a systematic trader. I have rules of engagement. So I have a watch list. Once any of these stocks, once they meet my entry criteria, I enter the trade and I manage my risk, right? So you can see here ODFL, its score is 2.10, and so far this morning has done 16.81. LUV, the score is 1.97, has done 11.26% this month, right? Even the S&P 500, it's not done up to 2% year to date, right? So just to show you that, if you just, your imagination, your creativity, and your innovation will set you apart, right? If you want average returns, fine, I'm not against average returns, but all I'm showing you is that there are rules to game. There are rules to the game of trading. You have to be creative, you have to be strategic, right? Manna doesn't just fall from the sky, right? We have to create our own system to be able to milk the market. To wrap up this week's video, I want you to know that across the global markets, the big message is balance, not urgency. US large caps, Nasdaq, and the world stock are telling us to be patient. Neutral trends mean this is a time for selectivity, not aggression. The real opportunities are more nuanced. US small caps and Canada show bullish mid-term structure despite short-term noise, which tells us pullbacks matter more than breakouts. Nigeria and gold continue to stand out with strength across both time frames, while oil remains supportive but not yet decisive. On the flip side, Bitcoin is still in a clear downtrend, reminding us that not all risk assets move together. So, this isn't a market for broad predictions, it's a market for alignment. When short-term and mid-term trends agree, you press. When they don't, you manage risk, stay flexible, and let price do the talking. That's how you stay on the right side of the market. Remember, it's all about data, not hype. Stay sharp, and we'll see you in next week's weekly digest. If you found this helpful, drop a like, hit subscribe, and share your market view in comments. I'll see you next week.